Hi, this is James from Absa Asset Management, and this is the July 2021 SARB MPC outcome update. Coming into this MPC meeting, a couple of weeks ago, we were thinking quite differently, with some evidence of normalization discussion coming into the MPC and some public commentary, with global expectations of inflation obviously there. And of course, with the social unrest in South Africa over the past couple of weeks, it has led to quite a seemingly different tone coming from this MPC meeting. And I must say, one of the more dovish MPC meetings I think we've heard for some time. So there were a few changes to the forecast, but pretty slight, and perhaps the biggest change coming in the QPM's guidance of the repurchase rate. So let's just take a look at some of the commentary. And of course, talking about the unrest slowing the recovery, vaccine rollout in emerging markets also slowing the recovery relative to developed markets, developed market policy, normalization uncertainties creating volatility of capital flows. Of course, we've seen that here in our bond and currency markets. He mentions when coming to growth that the benefits of the improved Q1 growth we saw this year will be offset by the negative effects of the social unrest on Q3 growth, but as a result, keeping 2021 growth unchanged at 4.2%, 22 at 2.3%, and 2023 at 2.4%. So no change to the growth outlook, and with the risks to that in the medium term deemed to be balanced. When it comes to the inflation outlook, they have changed the 2021 inflation up to 4.3% from 4.2. However, 2022 they moved down to 4.2 from 4.4 and keep 2023 unchanged, flagging fuel, food, and power prices as a risk to the outlook, as well as weaker currency and public salary prices too. So on the inflation side, the risks are deemed to be to the upside as well. Now, interestingly, the QPM, which is their tool that they, well, at least their indication of where monetary policy is going, there was a significant mark lower in the terminal rate for 2021, where the repo rate had been at the last MPC up at 4.07 at the end of 2021. Remember, it's at 3.5 currently. That's been moved lower to 3.79. So basically removing one 25 basis point hike. So this would indicate we're expecting, or the QPM suggests, one 25 basis point hike now this year, and moving 2022 slightly lower as well, but keeping 2023 unchanged. So what it's basically saying is a 25 basis point hike in November this year, and then for next year, a 25 basis point hike at every meeting. Now, this is probably the biggest change, as I say, from the MPC commentary. Now, in sort of conclusion, they do mention that the decision was unanimous. They say that they are still data dependent. So anything coming through looking inflationary, they will not hesitate to react to. They mentioned that prior to the unrest, growth actually would have been revised higher, which would have, of course, come through a little more hawkish in their commentary. But to better anchor expectations of future inflation, that will keep rates lower for longer. And there's three methods they talk about that this could be realized by: achieving stable level of public debt, of course, increasing the supply of energy, something quite topical at the moment, and then moderating the administrative price inflation by keeping wage inflation low into the recovery. Such steps, they say, will enhance the effectiveness of monetary policy and its transmission into the broader economy. So pretty clear on some steps that are required, so we can monitor those as well. But ultimately, a dovish commentary. How has the market reacted? Bonds have sold off ultimately. Bonds obviously benefit generally from interest rate tightening, so a much more dovish commentary coming through there. And we've seen a steeper interest rate curve as you'd expect, but weaker bonds in general. But also we're seeing a weaker currency too, the rand ending the day quite weak, down about 1%. So that's how the market has ended. What do we see as the outlook for investment? Well, a much more dovish outlook suits your income funds, which are currently yielding quite well because of the hawkish discounting that was in the market. So still a good time to get into shorter dated income funds. Bond funds will be more volatile going forward with as we're seeing the market react at the moment, and with the country risk premium seeming to increase at the moment after the social unrest. So staying with your core income fund, your tactical income fund, your income enhancer fund are the funds of choice at the moment, which have been doing well this year. Thank you very much for your attention, and until next time, this is James from Absa Asset Management. Thanks, goodbye.